Good afternoon. Hopefully you're all having a nice Saturday. I'm not sure when you're going to look at this, but this is my promise to get your recording of the other night's lecture. I'm going to do a little bit different. I'm doing it in the form of a video download. I'm also able to kind of write on these slides, so hopefully you'll get out of it what you got out of it on Tuesday, but you'll be able to stop and start it. And we'll see how this goes. So hopefully this works for all of you, and I apologize for not having the record button on Tuesday night. So make sure that you all remind me for next week. So this is chapter 3, and again we're taking a look at the Home Depot financial statements. And the statement that you should be looking at right now is what we call the income statement. Also called the statement of earnings, which you can see here. Those words are used interchangeably. What it presents to you is it presents the firm's revenues, which you see up here, expenses, which you see here, as well as their net income, or sometimes use net earnings, as well as if they're a publicly traded company, you will see stuff down here, the earnings per share. And if you want, you can follow along on your computer or somewhere with the slides if that's easier for you, because I'm kind of following along with the slides. What happens with the with this earnings statement is this net earnings dollar amount flows to the statement of retained earnings. So it flows to another statement, and we'll show you that. So therefore they call it the link between the balance sheet and the income statement, because the way that the financial statements are prepared is first is the statement of earnings is prepared, then the statement of retained earnings, and then the balance sheet, because the ending retained earnings dollar amount from the statement of stockholders' equity or the statement of retained earnings flows to the balance sheet as a line item. So that's why they call it a link between the balance sheet and the income statement. You will also see that all annual reports will show you 3 years of income of net earnings on one page. So you will always see 3 years of income statements and stockholders' equity information on the particular statements. The income statement comes in 2 formats. One is the multi-step, which is what you see here. This is a multi-step income statement, and a single step format. Multi-step format should be used for analysis purposes because you have a lot of different line items that you can do analysis on, like cost of sales, gross profit, selling, and administrative. So the multi-step format always has what we call intermediate profit measures prior to ending up at the net earnings. One of those, the first, is the gross profit, which is the pure profit that you get from just selling like an iPhone before you take any of the other expenses out. It's just the cost of the iPhone, you sold it at a price to a customer, and that's what your profit is on that. You then come to your operating profit or operating income, and that shows operating profit is the profit on your operations. So once I pay for the goods I sold, and then I take away all my commissions, my advertising, my depreciation, everything, this is the amount of money that I've made from my operations only. And that's because businesses sometimes may have other forms of revenue streams, but they're not their core business. So this represents the core business operating profit. And then third, you have this provision, the earnings before income taxes. So we want to know, hey, what is my earnings? what is my tax, and then what is the net of that, which is the fourth piece of that. So if we're looking at this statement here, this represents the multi-step income statement. If I'm going to look at a single step statement, then what you'll see is which is not Home Depot, but this is a single step income statement. And what you can see is that everything's grouped together. All the revenue is grouped together and all of the expenses. You can see income taxes aren't separate. Nothing's separate, all right? And so everything is grouped together. Regardless of the format, certain items must always be disclosed. One of those would be what we call discontinued operations. They need to be disclosed on either formats of these statement, and extraordinary transactions. So we're going to call out, let's say I have a division. If I'm Starbucks and I want to get rid of one of my divisions, the juice division, then I would put it here, okay? So as companies divest of some of their non-profitable divisions, you would need to call out what that means separately, and that would be an example of discontinued operations. If we have extraordinary transactions, something that you really want to call out and give visibility to, you would put there, okay? The other item that we have that we'll talk about a little bit later is something we call comprehensive income, and we'll talk about that here in a minute. If we go back to my the statement that's in the book, and this is an example of common sizing this statement. You guys should be pretty well versed on what that means to you at this time. Remember that it's an analytical tool. You can compare firms with different levels of sales or total assets. It allows us to look internally and do some what we call structural analysis. It allows us to evaluate trends and then make industry comparisons by bringing them down to a certain look, okay? And so when we do, so the formula for this, if you remember correctly, when we were doing it on the balance sheet, was the account balance divided by total assets. That is the formula when I want to common size a balance sheet. When I want to common size the income statement, the formula is still the account balance, but now it's divided by total net sales. So if we were to go ahead and look at this here, I'm going to go ahead and pull a calculator up here on my computer. So if we were going to go ahead and compute this here, we don't know what the numbers are, but if we went back and looked at the numbers, if we put the account balance of gross profit over total sales, we would come up with the 40%. So if we wanted to at the Home Depot account and we want to go ahead and take a look at the accounts, sorry, let me get this slide back up. Hopefully I'm able to make it a little larger for us. Okay, so when we want to take a look at this in that using that formula, and let's say we wanted gross profit, we would take the 28,000, that's the account balance, 954 divided by 83,000, 176. And if you take a minute and do the math on that, so if we take 28,954 divided by 83,176, we should get 34.8%. And if we round up, that would be 35% is the gross profit. Remember in class the other night, we did that for each of these years and they all came out about 35%. So you would be able to do this formula, the account balance divided by total sales, for each of these line items to common size it. So when we talk about common sizing, that's what we do when we talk about common sizing. It expresses each income statement item, that would be each line item here, as a percentage of net sales. So what it shows us is the relative magnitude of various expenses relative to sales, the profit percentages, and the relative importance of other revenues and expenses to the whole vision of that particular business. Okay, and so if we were to go down and common size each of this, we would come up with percentages, much like we did on page, if you go to the book, let me quickly just reference you there so you can go and take a look at that. Okay, so if you looked at page 107, you can see this particular page of Sage where they've common sized it using the dollar amounts on 105. And again, the formula is the account balance, so the line item balance divided by net sales gives you the common sizing for the income statement. Again, for the balance sheet, it's the line item divided by total assets. Okay, so let's go ahead and continue to talk about the Home Depot income statement. So the first line item that we're going to talk about here is what net sales is. So net sales represents sales revenue, so gross revenue, minus returns and allowances. Okay, so this net sales is sales minus returns and minus allowances. And so you ask yourself, hey, I think I know what a return is because we've all done that. We've all brought something back to the store. But what we might not know is what an allowance is. But you know, we've all experienced that as well. So an allowance is a deduction from the original sales invoice price. So if you go in and it says, you know, hey, the cost of this item is $10, but it's 50% off, that allowance is 50%. So on a $10 item, that would be $5. So sales are the major revenue source for most companies. So you're going to have a gross sales minus any returns, minus any allowances or discounts, if we talk about it that way. So if a company's sales are increasing or decreasing, it is important to determine whether the change is a result of price, meaning did I raise the price, okay, or whether I was able to sell more, maybe decreasing the price, but I got more value, or sometimes a combination of both, price and volume. So we always have to be able to go back and look into the notes of the financial statement or into the MD&A statement, the management statement there, to tell us why sales grew. And if it's something, the reason we're interested in that is it something that's going to continue or is it a one-time phenomenon? That's what's so important about it. Is it going to continue? Because then that might make us make different decisions regarding the company if we know, in fact, it is going to continue or it was a one-time thing. So when you have growth or decline, you'll be able to uncover the reasons why in the MDA in your 10K report, which is the management discussion and analysis. So talking again about net sales in that MDA, it'll tell us, hey, was it real? Was it real sales growth? Real sales growth means inflation adjusted, okay? Or was it nominal sales growth? And that's just as it was reported. So that MDA will tell us if it was real, adjusted for inflation, or a nominal, where it's reported at its face value. Sometimes you can have an adjustment of the reported sales figure with the consumer price index or some other measure of general inflation. That will always enable then the analyst to compare changes in real and nominal terms. So in the MDA, they will always refer to that. Okay, so next we're going to talk about the cost of sales, or another word we use for that is the cost of goods sold, also sometimes abbreviated as COGS, COGS. The cost of goods sold, or cost of sales, is the cost of the merchandise to the seller of products or services we sell to the customer. So it's what it cost us. It's the dollar amount that went into your inventory account. That number is affected by our cost flow assumptions of the way we've decided to value inventory. In other words, is it LIFO? Is it FIFO? Is it the weighted average? You will see that in the notes to the financial statement, as well as possibly some discussion in the MDA. So this, for most firms that sell stuff like the Best Buys and the Walmarts and so forth, and the Home Depot, is typically the largest expense they're going to have. And if you look down here, you do see that it is the largest line item here in that particular income statement. So when I want to take a look at a cost of goods sold percentage, in other words, a ratio of the cost of goods sold and net sales, sometimes it's important for profit determination. And so when I want to take a look at that, what I'm going to do is I'm going to do a formula. Let me see if I do not, but let's go ahead and move to this anyway so I have a cleaner copy. So what I'm going to take a look at is, how can I go ahead and show that percentage? So what you would do is you take the cost of goods sold divided by net sales. So if we did it in this particular situation, we would see that the gross profit is 35% or 34.8 or something to that effect. And you would be able to do it for each year. For each year, you'd be able to see, and then you'd be able to analyze any big swings. The MD&A, again, the Management Disclosures and Analysis, explains that lower prices on footwear in this particular company, it was Sage, have resulted in lower margins. So again, you're going to want to look in the MDA to understand what these numbers mean, okay, and if there's some large variances in it. All right, so we always want to understand the math, and the math here is that net sales is 100% minus the cost of sales, which in this case is looking like it's 65%, equals 35% of would be the gross profit, and we would go down. So the net sales is always your 100% that you want to add back up to get to make sure that those are also balancing. So the gross profit is also called the gross margin. Those are used interchangeably. It's always the difference between net sales and cost of goods sold. It's the first step of profit measurement, like we showed a few slides back, on the multi-step income statement. And it's a key analytical tool in assessing our operating performance. Again, to do the ratio of gross profit is expressed as a percentage, which we showed here. complement of the cost of goods sold, so it's the opposite or the difference in the cost of goods sold percentage. Firms want to maintain or increase gross profit. So here where I said this is how we got the the cost of goods sold percentage, we would do the same thing here for the gross profit or gross margin, is we would take that account balance and we would divide it by net sales, and then that's going to give us a percentage. And in our particular case, I think that I did this one wrong. So this should be 65%, and this one should be 35% if you did the math. I apologize, I was looking down. So this is 65%, and then this is somewhere around 35% as the gross profit margin. Okay, so firms always want to maintain or increase margin, because the more money you make here, the more money that you either can spend for like advertising here or R&D. And then if you don't spend any more money here, then it's going to drop to your bottom line here. Typically, it remains constant, as you will see here, pretty much 35% across this business in what we would call stable industries. In volatile industries, it may change. It may change drastically. Okay, so sometimes you might have to do the gross profit margin per revenue source, and that's if you have revenue and different costs of goods sold, but we're not going to worry about that right now here in this particular instance. So the next line item that we want to work at is the operating expenses. And the operating expenses include areas in which management has the most discretion to be able to exercise. In other words, do I give my employees raises? Do I give them bonuses? Do I cut them? I can manipulate my salaries. Do I spend money on advertising? Do I not spend money on advertising? So that's what it talks about, where management discretion can be exercised. It has considerable impact on current and future profitability. So if these numbers are really out of whack to the industry, then that might affect, the future or your current. It's important to track trends, absolute amount, your relationship to sales, and definitely any relationship to competitors. So if your competitors' salaries are, 30% of sales, then you would want to be that or less. You wouldn't want to be more than that, because then that would be more than the industry average, unless you had a good reason why, and perhaps you were something less than the inventory average on other line items. So operating expenses typically include selling and administrative, advertising, depreciation and amortization, your typical normal repairs and maintenance, and any impairment charges. Those are charges in which you might have to do a one-time thing, or your asset no longer has the value that it should for reasons, and you want to write it down. You would use that impairment charges. Operating expenses, those that we call selling and administrative, relate to the sale of products or services. They can include, and mostly do include, salaries, rent, insurance, and supplies. When we talk about advertising costs, should be a major expense when marketing is important to your element of success. We talked about that, like, with the upcoming Super Bowl, and Pepsi and so forth, and, how important. If I want to know what that percentage of advertising is, then I would take the advertising account balance and divide it by net sales. So if I did an example of that here, and I took $16,834 and divided it by 83,176, give me a minute, let me get my trusty calculator calculating here. So 16,000, and you can do this too as we go, 16,834 divided by 83,176 equals 20%. And so what that means is that 20 cents of every dollar, 20 cents of every dollar is used on selling, generally, and administrative. So if sales represents $1 or your 100%, then every line item under that is a portion of the dollar. So in our particular case, we have gross profit represents 35% of the dollar, and now 20 cents of that 35 cents is spent on selling and administrative. Okay, so that's how we want to go ahead and look at that. Also included in lease payments, in operating expenses are lease payments. Those are costs associated with operating rentals or lease facilities for retail outlets. So lease payments in a lot of times will look will feel like rent, like I'm paying rent on something. And typically you will always see them in the notes to the financial statement. Well, it will tell you what the lease payments are, what the rental arrangements are, how long it's going to be, what's your commitment. You can then judge if that's too much, or hey, I may not want to buy this company because I don't want to be stuck with this lease. For Sage, which was the example company we used in the textbook, it was in note 3 to the financial statements. It will be in your notes. It'll be just different from business to business. Also including in operating expenses are depreciation, which we talked about last week. And basically, to review, depreciation is just a cost of an asset other than land that will benefit future business years or enterprises for more than 1 year. And we basically allocate it over the asset's life. When we talk about amortization, it's the same, except for it's for long-lived assets that we amortize, something that's really long. Depreciation is used to allocate tangible fixed assets. Amortization is a process similar to depreciation for capital leases, leasehold improvements, intangible assets, such as patents, trademarks, copyrights. And then depletion is we use that just like depreciation, amortization, when it's natural resources. Okay. Sometimes we might want to find out what the percentage of depreciation is for Sage. To do that, if you went and looked at, I think in the textbook the other day, we went and looked at page 112. All you would do is take the depreciation expense number and then divide it by the total assets, building, leasehold, and improvements. And you saw that depreciation represents about 10% of the assets that we would be expensing each year. You can do the same thing for repairs and maintenance. Hey, does the repairs and maintenance tie to the building, leasehold improvements, and equipment? And you would just divide that. That's all on page 112. Okay. It talks here about repairs and maintenance, annual costs of repairing. You want to make sure you have an adequate view of that. When we talked about impairment charges, you can see here that Home Depot doesn't have any of that. And it's to recognize, to record a decline in the value of a long-term asset. Sometimes, most of the time, that's in conjunction with goodwill when it's no longer worth what we have it on the books. So we would want to go ahead and write that down. So the next line item that we're going to go take a look at is what we call operating profit. Here, we call it operating income. They're used interchangeably. You can also call it earnings before interest and taxes. And when we do that, we use the abbreviation EBIT, EBIT, which is earnings before interest and taxes. Okay. Second step of profit determination on a multi-step income statement, measure overall performance of operations, provides a basis for assessing success of a firm apart from financing and investing activities. And it's sales revenue less the expenses associated with for generating sales. We also call it the operating profit margin. The way that we would find that is we would take that number, 10,469. We would divide that by the 83,176, and we would do that on the Home Depot statement, and we end up with the operating profit margin of, hold on one second. Okay, of about 12%. Okay, so this would work out, it's about 12.5% is our operating profit margin. Okay. Then if we move down and we look at other income and expense typically can be dividend and interest income, interest expense, money you pay on the loan, any investment gains or losses, something we call equity earning or losses, and any gains or losses from sale of fixed assets. So if I'm selling equipment. So other income expense, firms that carry debt and equity securities such as trading securities report them here on any unrealized gains and losses that we include in earnings. We also can, if I sell equipment, if I have any accounting changes, extraordinary items, some investment in temporary investments, and so forth. So anything that's not equated to your particular business, your normal operations would go down here as an other income or an other expense. I always wonder about why interest is there because it seems like it shouldn't be because it should be normal for business, but not all companies have loans. So I guess, and maybe those loans aren't necessarily for your core business. Okay, so as we move down the line here, we're next at earnings before provision for income taxes. So this is earnings before income taxes. Income taxes paid may often differ between the expense because of deferrals, and the effective tax rate is the ratio before income taxes. So if I wanted to look at this, I would take the income tax here, which in our case is 36,331, again divided by 83,176. Oh, excuse me. I want to do it before earnings before taxes. So in this case, 99.76. So the earnings before taxes, 99.36. So if we do that, we're going to take 36,31 divided by 99.76. This is to get our effective tax rate, which, oh, that doesn't look right. I did it wrong. So let me try it again. 3631 divided by 9976 is 36%. So right now the effective tax rate is 36%. So that you take the income tax here divided by the earnings before taxes. Okay? Okay, so you just need to make sure that when you're a user of the financial statement, you need to be able to distinguish between earnings increasing due to core operations versus, tax-related kind of items, all right? Sometimes on the financial statements, as we talked about, you'll have some one-time items, discontinued operations, and extraordinary gains. If I discontinue a segment of my business, then I'm going to either have a gain or loss on that. And you need to know that because maybe now my sales won't be as big in the next year because I've discontinued this. And then you want to make sure that gains and losses that are extraordinary, that, those won't be reoccurring. Therefore, you can't always count them as income or a loss in that particular year. And so that works us down to what we call our net earnings, also called our bottom line, all right, also called net income. And it represents our profit after consideration of all the revenue and all the expenses. We often will also take a look at what we call the net profit margin, which is just basically a ratio of net earnings to net sales. So if we were going to go ahead and take a look at that here, let me go ahead and erase this a little bit. And then I'll go ahead and write it out again. Okay, so if I wanted my net profit margin, I would take earnings, 63.45, divided by 83,176. And if we go ahead and run the calculator on that, we get 63.45 divided by 83,176. 83,176. So 63.45 divided by 83,176 gives us 7%. And so our net earnings or our net profit margin for the Home Depot for 2015 here is 7%. Okay, so that's how we come up with that. Then if you come down to the bottom here, and I think I have some additional. Okay, so let's go ahead. I don't have a blank slide. I tried to find one. So let me go ahead and just talk about earnings per share. So net earnings available to common stockholders for the period divided by the average of common shares. So what happens is it's strictly a calculation here. You take the common weighted average for the common shares. So if I erase this a little bit, give myself some room. Okay. So what I would take is the 1,338 shares, and I divide it into 63.45. So 1,338 divided into 63.45. So 6345 divided by 1,338 gives me $4.74. So for every share I own as a stockholder, I earned $4.74 based on the earnings that were provided by the Home Depot. To get the amount diluted per share, you would replace this with 1346, and then you're going to get 471. And what happens with that is then that becomes the diluted share amount. And when we talk about it, that when we have diluted shares, it's typically with firms with very complex capital structures. They'll give you both basic and diluted. Analysts should always consider material changes in the number of common shares of stock outstanding to see what everybody is in fact selling at this point. Okay? No, that goes to stockholders' equity. Okay, so here we have what we call the stockholders' equity section, and it's on a separate statement. And in this one, it's pretty complex. But it's an important link, again, between the balance sheet. You'll be able to see that net earnings figure come right here. This net earnings figure will come right here. And then you get to see all the changes that happened between that statement. Okay. You'll get to see if there's dividends, if there were stock splits, and all of those kind of items within here. Forward. That gives me that.